You have an environment in China which is changing and becoming more difficult. Individuals, 70% of their money was in real estate. Real estate has gone down. Stocks have gone down. Salaries have gone down. And as a result, they're not spending and they're concerned and they're holding money in cash. Situation that's more challenging than Japan in 1990.
I wouldn't quite say the Chinese economy is in very dire straits yet, but it's getting there. And the one concern I have is that there hasn't been very much stimulus, and the longer the Chinese government waits to infuse monetary stimulus in particular, but even fiscal stimulus, that stimulus is going to be a lot less effective in supporting the economy's growth.
China's economic growth has been unprecedented, but is experiencing a significant slowdown. Factors such as a property crisis and deflationary pressures contributed to this decline, the most severe since the 1998 Asian financial crisis. The stock market has lost around $6 trillion in value over the past year and a half, and unemployment, particularly among youth, is rising. For the past 2 decades, China's economy experienced unstoppable growth, evolving into a major manufacturing powerhouse. GDP growth consistently reached double digits, lifting millions out of poverty and expanding a burgeoning middle class. This growth benefited various multinational companies, from Volkswagen to Estee Lauder. However, the pandemic brought significant disruptions, particularly due to China's strict COVID-19 policies that led to widespread business closures. Geopolitical tensions, especially with the United States, have further complicated the economic landscape, reducing foreign investment. The property crisis, driven by rapid debt accumulation among developers and local governments, has eroded confidence in the economy, causing investors to flee the stock market. Recent data from China paints a bleak economic outlook, prompting analysts to revise their GDP growth expectations downward. Professor Eswar Prasad from Cornell University highlights that long-term issues related to property prices and short-term challenges in domestic demand signal a troubling economic future for China. There hasn't been much good news in this latest round of data, and this has been the pattern for the last few months, says Eswar Prasad, professor of international trade and economics at Cornell University, on CNBC's Street Signs Asia on Monday. He warns that Beijing's economic outlook for the year's second half is now flashing red or pretty close to red. Let's now watch the clips from the interview with Professor Prasad, where he shares his insights on the Chinese economy.
There are a lot of warning signs flashing red or pretty close to red. There hasn't been much good news in this latest round of data, and this has been the pattern for the last few months. Both the long-term issues related to property prices and so on, and the short-term issues related to domestic demand in particular, especially private investment and household consumption, have not been doing well at all. So the economy does seem to be relying on exports to a significant extent, and we are seeing the production side, which was holding up reasonably well until a few months ago, also beginning to weaken. So I wouldn't quite say the Chinese economy is in very dire straits yet, but it's getting there. And the one concern I have is that there hasn't been very much stimulus, and the longer the Chinese government waits to infuse monetary stimulus in particular, but even fiscal stimulus, that stimulus is going to be a lot less effective in supporting the economy's growth. At a time of declining business and household confidence, using monetary policy requires fairly significant action. It also requires early action, and we haven't seen either of those from the Chinese government. But of course, you need more than macroeconomic stimulus. You need broader reform measures to revive confidence. But at the minimum, you do need support from both monetary and fiscal policy, and it's been quite minimal so far relative to where the economy is in. So I think there are good reasons to be concerned about the trajectory of the Chinese economy in the coming months of the year.
In contrast, billionaire Ray Dalio, founder of Bridgewater and a longtime bull on China, acknowledges the country's pressing challenges. Speaking to Bloomberg in Singapore, he stated, "There are real issues within China's $17 trillion economy amid a deepening slowdown." Dalio points to the changing environment, marked by declining property and stock prices, and suggests Xi Jinping's economy may confront challenges more difficult than Japan in 1990. Despite these concerns, Bridgewater isn't fully pulling back. Dalio emphasizes that a small percentage of our portfolio is in China and will stay in China through this process. He believes China remains a very attractively priced place, provided investment strategies are carefully considered. However, this perspective becomes increasingly uncertain with each passing month. As of August, Chinese industrial production has experienced its longest slowdown since 2021, driven by weakening investment and consumption. These growing headwinds put pressure on President Xi's administration to implement measures that will help achieve the country's 5% growth target. Before we explore Ray Dalio's insights, please subscribe to the channel, like the video, and hit the bell icon so you never miss any uploads.
I think that there are real issues in China now, and they changed really in the last 4 years. And that is that they need a restructuring. A lot of the spending, let's say, individuals, 70% of their money was in real estate. Real estate has gone down. Stocks have gone down. Salaries have gone down. And so, and as a result, they're not spending and they're concerned and they're holding money in cash. With deflation, cash is a relatively good asset class. That's kind of the household and the business sector is in that state. At the same time, you have the government sector is a problem because most of the government spending, 83% of government spending, is spent by local governments. Those local governments got their money by selling land for real estate. Okay, there are no land sales, and they borrowed a lot of money, and those that they borrowed the money don't get paid. And so the question is, how are you going to get money into those places to operate? It's a situation that's more challenging than Japan in 1990. It needs a restructuring in order to be able to do that. And then there's also the question is the property values, the property ownership. Is it respected? And Deng Xiaoping during his period said it's glorious to be rich. Is it still glorious to be rich? So you have an environment in China which is changing and becoming a more difficult environment. So it's the time right now that you would see either is there going to be a restructuring and a getting past that. The innovation, yes, there's fantastic innovation. In terms of technology, there's nothing like it other than in the United States. Europe certainly isn't a competitor in that. However, it's very much government directed. Can there still be entrepreneurship and that inventiveness? These are big cosmic questions.
Ray Dalio has strongly supported China within the hedge fund community, often highlighting its potential in his essays from 2019 to 2020. He also criticizes the growing anti-China sentiment. Dalio believes that successful countries are productive and financially stable. He encourages those skeptical of China to put aside their biases and consider the opportunities it offers. However, the economic situation in China is changing and concerns are rising. The housing market, crucial for growth, is under much pressure. Experts like Batson suggest that the housing bubble is at a breaking point, indicating a necessary correction is coming. If consumer spending drops during this adjustment, the expected recovery could be delayed, making economic growth harder to achieve. Dalio's acknowledgement of real issues in China indicates increasing uncertainty. This shift could have significant global implications. Companies that have relied on Chinese growth may face tougher times, impacting their operations and spending strategies worldwide. The slow return of Chinese tourists to international destinations is another worry, especially for economies that depend on their spending. A slowing economy could also complicate the Chinese government's ability to maintain control. When the economy is strong, people tolerate government restrictions, like free speech limits, for stability and growth. However, if the economy falters, it could lead to more dissent and pushback against those controls, creating a more unpredictable political landscape. As these issues unfold, it's clear that the challenges facing China today could resonate far beyond its borders, affecting the global economy. Investors and policymakers must stay alert and adapt to these changes, as the interconnected nature of today's world means shifts in China can impact everyone. What are the most significant challenges facing China's current economy? And how might they impact the global market? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.